Okay, so here's our video on Chapter 21, Cost, Volume, Profit. This is my favorite chapter in accounting, so hopefully you'll think it's fun. It's very different than some of the stuff we've been doing. So we've been talking in the second half of the course about understanding the different types of cost. And we talked about product versus period costs and direct versus indirect and all those types of things. But now what we really want to talk about are the difference between fixed and variable costs. A fixed cost is one that does not vary with production. So it's not something that never changes. It's something that doesn't change just because production changed. So for instance, your advertising is a fixed cost, and you could change it every month based on changing your mind on how many ads you put in and that kind of stuff. But it's not varying because production. Variable costs are ones that vary in direct proportion to volume. So, for instance, your direct materials and your direct labor would fall into this one. If you produce 20% more, you need 20% more of these costs. If you decrease your production by 10%, you need 10% less of those costs. So really, when there's a couple exercises in the demo problems where you can practice this. And if I make more, do I need more of this? Then yes, it's a variable cost. So a fixed cost, if we, that's not very straight. If we want to plot that out, this being the quantity that we produce, and this being the cost, a fixed cost looks like this. It's the same whether I produce 1 or whether I produce 500. The cost stays the same. Let's say this is $300. Whereas a variable cost looks like this. Here's my quantity, and here's my cost. It goes up like this in direct proportion. So if I don't produce anything, the cost is 0. The more I produce, the more the cost goes up. So the total cost stays the same across varying levels of production, whereas over here the total cost increases the more I produce. However, if you took these as a per unit, if you took the total cost divided by the number of units, the per unit cost for the fixed cost will keep decreasing, which is not on this graph, because I'm going to take that $300 and divide it by a bigger and bigger number. Whereas here, the per unit cost stays the same. So let's say it's $5 a unit for my direct materials. It's $5 per unit no matter how many units I produce, but the total will keep going up. And then we have mixed costs. Okay, and these are ones that have a fixed component plus a variable component. So they would look like this. I'd start out here, and so this much here is the fixed component, and then this shows you the variable. And with both of these, the slope of the line actually tells you the variable cost per unit. I'm not going to make you calculate the slope of the line, so don't worry. But this would be things like sometimes your electric bill would have a fixed component. I need this much just for heating and lighting in the building. And then after that, the more I produce, the more I run the machines, the more my electric bill goes up. So some things have a fixed and variable component. Which brings us to this, cost estimation. Now, in managerial accounting, we actually discuss a bunch of different methods of managerial of cost estimation. We're going to do high-low in this one, which is probably the least accurate, but it has a really helpful thing. So this will help us take a mixed cost and break out the fixed and variable components. So I'll be able to separate the fixed portion of that cost from the variable portion of that cost. And keep in mind that total cost will always equal the fixed cost plus the variable cost. It has to fall into one of those categories. So I can take those mixed ones and I can figure out, if it's my utility, I can figure out how much is fixed and how much is variable. So I'm going to walk you through the 5 steps here, and then I'll take a problem out of the demos to kind of show you. So the first thing you want to do is identify the highest, and lowest activity levels. So the month, let's say you've got a 10 months worth of data. And for each month, you know the month, you know what your total cost was, and you know what your activity level was. So you pick the highest month for activity and the lowest month of activity. And then so from some past data that you have, you've got 6 months worth. The more data you have, probably the more accurate it's going to be. And then you identify the costs that go with those months. The costs with those activity levels or those data points. So, you've got a year's worth of data, and you see that February was your lowest month and August was your highest month as far as activity. So then you take the cost that goes with February and the cost that goes with August. And so now you have these two data points. The second step then is to calculate the variable cost per unit. And we do that by looking at the change in the total cost divided by the change in the activity, or I'll say the volume. Oops. So high cost minus low cost divided by, high activity versus low activity, like how many units I produced. And that'll make more sense, I think, in the next problem. Once I have the variable cost per unit, I can use that to figure out the fixed cost, the total fixed cost. Because I know that total cost equals the fixed cost plus the variable. I know the total cost, that's the original data I had, and now I can figure out the variable cost because I know the variable cost per unit, so the difference must be the fixed cost. So the fixed cost will be the total cost minus the variable cost per unit times the volume. That would be my total variable cost. So I take my total cost minus the variable, the rest of it has to be the fixed cost. Once I have those 2 points, I can create and use what I call the formula, and see it's capitalized so you know it's important. And that is just for any month, the total cost will always be the variable cost per unit times the volume plus the fixed cost. Because that variable cost per unit stays the same and the total fixed cost stays the same. So all I have to do is plug in a volume and I get it. For this one here, use either the high or the low point. It doesn't matter. But use one of the points that you identified up here in step 1. And then the last step, it's always a good idea to check this formula against your original data. So let's just do one of those here so you can see what I mean. Mel owns a machine shop, and in reviewing his utility bills for the past 12 months, he found that the highest bill was August, and he had 2,600 and 1,400 machine hours, and his lowest activity was 900 machine hours, where the bill was 2,300. So now we've got the high and low point, so that's step 1. He already did that. So the first part of this question, we're going to calculate the variable cost per machine hour and the total fixed cost. So the variable cost per unit will be the change in the total cost divided by the change in the volume. So the cost, we have 2,600. The low cost was 2,300. And with the activity here, the high was 1,400 and the low was 900. So now I've got 300 over 500 gives me a variable cost per unit of 60 cents per machine hour. Now I can plug that back into either one of these points to get the total cost. So the fixed cost will be the total cost, I'm going to use August, so 2,600, it would be the total cost, minus 60 cents per unit times, in August we had 1,400 machine hours. So that'll be my variable cost. That comes out to 840. So that means if the total cost was 2,600 and 840 of that was variable, the difference, or 1,760, must be my fixed cost. Now I can show the equation. So that's the formula. I'm going to put that up here just to save room. So the total cost for Mel, his the utility, his total utility cost will always be 60 cents times the number of machine hours that he does plus 1,760. And then step 3 says, all right, if he's expecting 1,000 machine hours in January, what's his total utility bill going to be? So we plug that formula in. His total cost, his total utility bill, will be 60 cents times 1,000 hours. That's going to be his variable cost, plus 1,760. That's going to be his fixed cost. So this is 600 plus 1,760. His total utility bill should come out to 2,360. So that's cost estimation. There's the drawback of this one is that, let's say you have 100 data points. You're only using 2 of them. And so statistically, this isn't going to be as accurate. There's more accurate methods that use all of them. But this is really handy for us being able to break out the fixed and variable, which we'll need for the rest of what we do. Okay, so the next thing I want to get into is this cost, volume, profit relationship. Understanding the relationship between cost, volume, and profit is really key in decision making. So we'll start out by looking at the basic equations, some practice calculating those, and then we'll actually use them to kind of make decisions. So the break-even point is where I have no profit, but I have no loss either. And so my net income, or my operating income, is 0. Okay? This is not the goal. This is not our goal. This is just a starting point for decision making. So I think you'll see what I mean here. So, but this is our starting point. So if we go back to the income statement, we know that our sales revenue minus our total costs equals our profit. We also know that total costs can be split into fixed and variable. So we could rewrite it like this. Sales revenue minus variable costs minus fixed costs equals profit. And I can do my sales revenue will be the selling price per unit. So SP equals the selling price, so that's per unit, times the number of units that I sell, minus my variable cost. So VC will be my variable cost per unit. So my variable cost per unit times the number of units I sell, minus my fixed cost, which will be total. And if I'm breaking even, my profit or my operating income is 0. So now I can use the magic of algebra to kind of rewrite this, right? And so I can say the selling price minus the variable cost times the number I produce minus my fixed costs equals 0. I can rewrite that. Selling price minus variable cost times the number. I subtract fixed costs from both sides. And so now my equation looks like this. And so then I can rewrite it. The number that I need to break even, BE's break even, equals my fixed costs over selling price minus variable cost. This is super important right here. So here, let's put a big red arrow there. That's an arrow, sorry. Also, this thing right here, this selling price minus variable cost per unit, is my unit contribution margin, UCM. Very important right here. And this equation right here, both of these are kind of foundations to what we do in this chapter. So the number of units I have to sell to break even can be determined by taking the fixed cost divided by the selling price minus the variable cost, or the UCM. Everything I sell beyond that, I start making profit. So this is how many units I have to sell just to cover my fixed costs. Once I've got those covered, everything is profit. And this tells me the profit per unit. The contribution margin tells me the profit per unit after I've covered my fixed costs. Okay, so let's talk about this contribution margin. Oh, so just to reiterate there, the break-even in terms of number of units equals the fixed cost divided by that unit contribution margin, which is the selling price minus the variable cost. I know I just wrote that on the last page, but I'm putting it here again. Let's say I don't want to break even. I want to earn $10,000 in profit. You can get the same thing. You can say the fixed costs plus your target profit divided by the unit contribution margin tells you how many units you have to sell in order to earn that target profit. So that's another kind of important formula there. Now, let's do contribution margin. We can rewrite the income statement in the contribution margin form. Now, before we took an income statement and we said the sales revenue minus the cost of goods sold equals gross profit, minus the selling and administrative costs equaled your operating income. So now, I don't care if it's direct or indirect or cost of goods sold or selling and admin. Now what I care about is fixed or variable. So I could rewrite the income statement like this. So total sales revenue minus total variable costs equals my contribution margin, or my total contribution. Then I subtract off my fixed costs, and that gives me my operating income. So we have some that we'll look at that'll kind of take that form. Okay, the next thing I want to talk about is contribution margin ratio. And this is CMR, is what I call this one. Fixed cost over contribution margin ratio. If you put contribution margin ratio on the bottom instead of the unit contribution, this tells you break even in dollars. So instead of telling me the number of units I have to sell to break even, this tells me the amount of sales that I have to have. Sales dollars needed to break even is what CMR tells you. The CMR tells you the percent of each sales dollar, of sales dollar that contributes to the fixed cost, or once fixed costs are covered, goes towards profit, or straight towards the operating income. It's showing you contribution as a percent of sales. So you can do it in total. So CMR can be total contribution, not the per unit, but total contribution margin over total sales revenue. Or you can do it per unit. So you could do the unit contribution margin over the selling price per unit, and you'll get the same thing either way. This also tells us, it defines a relationship here that's kind of important to understand. So we said that the selling price minus the variable cost equals the unit contribution margin. So these three things have to add up. So if I came up with, let's say my contribution margin ratio is 60%. Okay, you'll always see it as a percent. That's what I figured out here. That tells me of each sales dollar, of that selling price, if 60% of that is going to contribution, that means 40% is your variable cost, because these three things have to add up. And that can be a handy relationship either, because that relationship will always be the same. The total sales volume will change, but even if my sales go up or down, variable costs are always going to be, in this example, variable costs are always going to be 40% of the sales revenue, and contribution will be the other 60%. So once you know one of those, you can figure out the other, and that relationship will always be the same. So let's just do a couple problems here to get you started. Garson sells a product. These are all in the demo problems, but I'm not doing all of the demo problems. Garson sells a product for $90 per unit. The variable costs are $60 per unit, and the fixed costs are $800 a month. They expect to sell 540 units in September. Calculate the contribution margin per unit in total and as a ratio. And with some of these problems, if you're doing it in my lab, it just has you do it one way, but I'm going to show you a couple different ways to get to the same number so that hopefully you start to kind of see the relationship here with you. So the unit contribution margin is the selling price minus the variable cost. So in this case, the selling price is 90, the variable cost is 60, so the unit contribution is 30 per unit. They asked for that in terms of, so they asked for it in number of units and in sales dollars. So I could do it a couple different ways. I could take total sales revenue, which will be $90 a unit times I'm selling 540 units. So my total sales revenue is $48,600 minus my total variable costs. And my variable costs are $60 a unit. I'm selling 540 units. So my variable costs are $32,400, which means my total sales revenue minus my total variable cost, total contribution margin is $16,200. So I have to sell 30, yeah, that's what, so this is my contribution per unit. This is my contribution in total. The other way I could have done this was to say $30 a unit times 540 units, if that's what I sell, gives me 16.2. So either one is correct. And then the other thing they asked you for is a ratio. So the contribution margin ratio, again, you can do total or unit over unit. So I could do total contribution of 16.2 over total sales revenue of 48.6, and I get 33%. Or I could do it per unit. The contribution per unit is 30. The selling price per unit is 90, and that gives me 33%. So either way here is right. You know, you can take it either way. I like the smaller numbers, and I like to use fewer numbers if possible. But sometimes, like I said, in Pearson, it kind of makes you do it one way because you're filling in the blanks. But I do like you to see there's more than one way to get to the right answer. Okay, here's another one. Gabrick Company sells a product for $30 a unit. Variable costs are $20 a unit. Fixed costs are $2,500 a month. The company expects to sell 560 units in September. Prepare an income statement for September using the contribution margin format. So I'm going to start with the income statement because that's what this one tells you to do. But then I'm going to show you two other ways to get to the same operating income. So my net sales revenue will be $30 per unit times 560 units. So that is 16.8. My variable costs, my total variable cost will be $20 a unit times 560 units. So that's 11.2. which gives me a total contribution margin of 5,600. And then you subtract off your fixed costs, which were 2,500, and you get an operating income of 3,100. Operating income. Okay, so that's the way they asked you to do it in the problem. And I just want to show you a couple more here. One of them is I can go up here or down here and I can say, okay, my unit contribution margin is the selling price of 30 minus the variable cost. So it's 10. $10 per unit is the contribution, and I sold 5,600 units, so I get total contribution of 5,600. That's what I got right here. And so, unless it asks you specifically, instead of doing 30 times 560 and 20 times 560, I can just skip straight to the contribution. Oops, that's not it. Times 560 units gives me total contribution minus my 2,500 fixed costs, gives me operating income of 3,100. And then the other way to get the same thing is I could skip, even though it hasn't asked me to do this yet, I can skip up here to break even. So the break even in terms of number of units is the fixed costs over the unit contribution margin. So in this case, that's 2,500 over 10. So the break even, I have to sell 250 units to break even. I'm expecting to sell 560. In order to break even or to cover my fixed costs, I need to sell 250. So that is 310 units above break even, each one of those contributing $10. So I get 3,100 is the operating income. That's the unit contribution there. So once I know how many I need to break even, everything after that is contributing to my profit. So if I sell 310 units beyond that break even point, each one of those is going to contribute $10 towards my profit or my operating income, and that's 3,100. So 3 different ways to get to the same number. Okay, I'm gonna pause this here and then do the rest of it in a second video, so this doesn't get too long. There's a lot in this chapter, so we'll use 2 videos here. Okay, I'll be right back with the rest of it then.